Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today I wanted to explore this question. Is it really true that a trader can get paid to buy a stock that they already wanted? Well, when we sell into a put, we're entering into a contract where conceptually, yeah, we're collecting a premium where somebody might be paying us to buy a stock that we may have already been interested in. But we need to explore the risks associated with that sort of approach as well. I think this is going to be an interesting discussion. We're going to be planning and placing a short put to enter into that sort of a contract today. But before we get to any of that, let me first of all say hello to everyone who's already chatting in. Great to see all the familiar names. Hello to anybody that might be new. But hello there, JDLMI and Selva, Eva, Sam, Mark, Will, Joseph, Tony, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you are among those who are here for the first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us here in the live stream audience if you'd like to be here. This is a Monday webcast series. We kick things off promptly at 2 Eastern time. Now, I also want to let you know that my very good friend Barb Armstrong is hanging out in the chats with the live stream audience. She's going to be keeping an eye on any questions that come in. And if I can't get to those, Barb's just there to pick up my slack for me. Barb and I have been working together for years and years and years. She brings a lot of experience to this discussion. Thanks for having my back there, Barb. And Barb and I would also like to issue an invitation to everybody listening, whether you're watching live or you're checking out that archive. Please do follow your favorite Schwab presenters on social media. It's the way to connect with us in between the live streams. So you can find us on X or on LinkedIn. You can find Barb on X at Barb Armstrong CS. You can find and follow me on X at Cameron May CS, or you can hop over to linkedin.com/in/Cameron May CS. Barb has already linked those in the chat. Thanks for doing that, Barb. But let's get into this discussion. And of course, as we do, we need to consider the risks associated with trading and investing. This is important information, certainly applies to selling put options, but options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so with that important information delivered, let's set the agenda for today's discussion. The very first thing that we're going to do, as we always do, is take a quick peek at the existing positions within our paper money portfolio. Then we're going to pop over to the S&P 500, see what's happening there, and use that as a backdrop for today's discussion, which is selling a put, entering into a contract where a trader may be collecting some upfront potential income in exchange for the obligation to buy shares that we might have already been interested in buying anyway. So this is going to be an interesting discussion. We'll tell about what selling a put entails, the obligation associated with that, the risks that also accompany selling puts, but then we're going to be planning and placing an example trade before we're done. So, yep, Mark says, Cam, it's short puts today. It's exactly right. You're looking forward to it. That's fantastic. Let's get right to the Thinkorswim desktop. This is the paper money version of the trading software. And right now we're in 4 positions in our example portfolio, but Broadcom, we just have 100 shares. What happened there? Well, this was a covered call. That contract has expired. Boy, it expired. We actually saw that get to expiration by the skin of our teeth, then not get assigned there. If a trader has a concern about that, that's what's happened to us. Let's go have a look at Broadcom and its full history. So with Broadcom, we bought 100 shares right here on July 20th at $380.37. At the same time, we sold an August 21st 410 call. That call ultimately expired out of the money. We collected and retained a premium of $11.95, so $11.95 per share profit was realized. And after that expired, we then sold a 28th of August $370 call. Now notice, when we sold that call, that strike was below what we paid for our shares originally. Now, we throw in the premiums collected, and that was still above our break-even point. But these contracts have now expired, and I said just by the skin of our teeth here. Let's zoom in a little bit. And you'll see here's our strike at that 370 level. The day before expiration, price closed above 370. And in a real account, when we're this, particularly when we're this close to expiration and in the money, it raises the risk of early assignment. Now that early assignment is not a risk in paper money. No contracts are assigned early in paper money, but it can certainly happen in real life. So this was not assigned, even as it climbed higher on the day of expiration, not assigned. And we ultimately wound up peeling back and closing at 368.79. That's $1.21 by my math, below our strike. Expired out of the money. We're starting to climb again. Now we had a plan here in place. If we broke down below this support, we were going to discuss maybe getting out. We did go down below that support for maybe a couple of hours. This was back on Wednesday of last week, but we've rallied. So we didn't really have an opportunity to talk about it at the moment that we were kind of piercing down through that support. We've rallied. We're still above that support, so we're not going to exit, but we do have an earnings announcement right around the corner. Now, we've talked about in the past the pros and cons of selling calls as we go through an earnings announcement. If you didn't catch those discussions, make sure, first of all, if you're new to Schwab Education and you're new to this channel, make sure you subscribe to the channel. You can just click on the subscribe button down below the video. It only takes a second to do that. It doesn't cost anything. But that's where you can join our live streams, the Trader Talks Schwab Coaching Webcast channel on YouTube. You can join our live streams on our homepage here, or you can find the playlists of previous webcasts. So if I go to playlists and I scroll down through all the different webcast series that we have, it's kind of toward the bottom. Right down here, there's our full playlist for the Covered Calls and Short Puts webcast series. And we can see recently, where did I do? There it is, just a couple of weeks ago. Selling calls before earnings? Is it possibly the perfect time to sell calls? Well, obviously there are pros and cons, but I think we're going to do that today. Let's go back here to our Broadcom position. And interestingly, last week, when we sold this 370 call, you'll see how close that was to the current price of the stock. It really only took about a day or so to put that in the money. And that was for a 345 premium. I wonder how far away, with this earnings announcement coming, how far away might we be able to put a strike and still collect something along the lines of $3 and change again, with our stock trading around $370. Maybe if we're looking for, let's say, an example, 1%. Let's look at the September contracts and see how far we can push this away as compared to how close we had to be with this very short-term contract that we sold last week. So if we go to the trade tab, let's make sure that we're looking at Broadcom. Let's go out here to the 18th of September and looking at the calls. Man, look at those strikes. As we go further and further and further out of the money, those prices are still comparatively strong. Now that's because of that earnings announcement. Options premiums tend to go up in price right before earnings. This is a reflection of the demand that can happen right before an earnings announcement for options from speculators and from hedgers. But if I look out here, it looks like that 430 strike, we might still be able to get $3 and change, maybe $3.35, 40 cents. 430 on our chart is up here. Let's draw in a line. Actually, I'm going to intersect it with these highs back here because it happens to be right around those highs. It's right around there. I'm going to tailor this just slightly. Let's make this precise. Let's put this right at 430. So we can right click on a line that we've drawn and select Edit Properties and then change the start and end points there. So that's now right at yeah, there it is, right at 430. Okay. So look at that distance above our strike. That's a reflection of the heightened premiums that are very typical right before an earnings announcement. Mark says, yeah, selling calls 3 days before earnings, always a lot of fun. Can be fun, right, Mark? The fun part is premiums are high. The not so fun part is we still have the associated risk if the stock price drops hard. We're the owners of the shares, so ouch. We'd have a bit of a premium there to maybe help us feel a little bit better about any kind of drop that might develop. But also, if the stock happens to spike above our strike, maybe we might have to sell the shares for less than what they ultimately wind up being worth. But I think we're going to do that. Let's go to our trade tab. Let's go to that 430 strike. I'm going to click on the bid price. Let's bring up, we just own 100 shares, so let's just sell one contract. And how about we see if we can get, what if we were okay with $3.30? That's not quite all the way to the mid. It's a little bit better than the natural. Let's see if we can get a fill there. I'm going to submit that as our limit order and click confirm and send. So we're attempting to sell that one call for $3.30. That would introduce $330 of potential income. This says there's a maximum loss that's infinite. That would be true if this were a naked call position. We own the 100 shares in this same account, so this is not a naked position. We do have to pay a commission if the order fills, though, 65 cents. But let's send that order off, and we'll let that work. Oh, there we go. Sold it right at $3.30. Okay. Very good. So we'll see how this earnings goes, but really the break even now for this, if this goes up above 430, 330, it could go all the way up here, and it would be an optimized outcome. Anyway, let's go have a look at our other three positions. They won't take nearly as long. We'll just pop through these. We have Cardinal Health, own 100 shares right now. We've sold that 240 call for the 18th of September. Here's the full history of Cardinal Health. The shares were actually purchased more than a year ago. Then they kind of sat, and then we started selling calls against those stock shares in April. In April, we sold a call, realized a profit of $1.16. July, we sold a call and realized a profit of $4.65. In August, for the 7th expiration, sold a call, we realized a gain of $171. Sold a call for the August 21st expiration. That one has expired for a $6.90 profit. Most recently, we sold the September 18th 240 call. That's right here. So we're still just below that. We're going to let that continue to work toward that September 18th expiration. With our Alphabet position, we own 100 shares. Right now, we're in an 18th of September 370 call. So here's the history for Alphabet. Looks like our drawing set defaulted. So with Alphabet, we bought 100 shares at 349.11. We sold some June calls, realized a gain of 13.40. Sold July calls, realized a gain of 3.15. Sold some August calls. That one we closed for a 7.30 profit. And now we've sold in the September expiration, that 370 call for 3.40. So there, for reference, is where that strike is. And now we're hovering right down below, or not below, or just near a support level. We're going to keep an eye on this. If we happen to break down below that support, even though this has been good for income so far, if we start losing more money on the stock that we're making than we're making on premiums, that's still not a profitable overall scenario. We're still above our break even thanks to all of these premiums that we've collected. But we'll keep an eye on this. We're going to let that continue to work, although I'll also say for some traders, they might look at the trade price, that the premium that was originally collected of 340. We might be able to get out for a fraction of that, maybe 25% or so of what we originally collected. We might be able to realize most of that maximum gain on that call if we were to exit. I'm not going to do that today. I'm going to let that continue to work. That finally brings us to ExxonMobil, where we own 100 shares, and we've sold the 18th of September 170 call. And here's XOM. So with XOM, bought the shares right here. Shares are doing well. We recently sold that September 18th 170 call. We've stayed below that strike, although today we've been working our way toward it, but still some time to go. That one's doing fine. I'm going to let that one continue to work. So that's how things now stand with our existing positions. Let's go see what's going on with the markets. I want to have a quick peek at the S&P 500. And I wanted to look at today, in particular, a couple of levels for the S&P. Bit of a selling off day today, just down a fraction of a percent. It's not a huge down day, but we are trading down how far? Maybe 1.5%. I'm going to measure that. Let's use our drawing tool. Our trend line tool can be used as a measuring device. If I move down here, keep your eye on this right over here. See where it says percent change? That'll tell us how far down below those highs we are. It looks like, yeah, just a shade short. We're somewhere between 1.5% and 2% down from those all-time highs. That's not a great time for stock ownership. It's only a few weeks, but it has been a productive time for a lot of covered call positions where it's just really time going by, price peeling back a little bit, reducing the value of those calls that have previously been sold. So that's been helping out our positions. But I think I want to take a different approach today. Let's look at maybe selling a put. So looking at these two levels on the chart, we might see that the S&P's kind of settled into a bit of a trading range for the moment. And really, as we look into September, September is one of the weakest months of the year, at least it has been on average over the last 20 years. Now, so for share ownership, at least over that time frame, on average, it hasn't been a great time. However, let's say that our trader is still out there, still thinking, hey, okay, once we get past September, October, November, December, actually, that is historically the strongest quarter of the year. I actually have done a couple of posts on social media recently about this. Yeah, very true to say that over the last 20 years, that last quarter has been much stronger than the other three quarters, up on average about 4.9%. So let's say that our trader here or our investor is looking a little bit ahead and they think, you know what? Rather than buying some stocks today, maybe I'll go find some stocks that I would like to buy. And let's get into maybe an agreement with another trader where I agree to buy shares from them, but not for today's prices. Let's agree to buy shares at lower prices. Maybe if September delivers a little bit lower prices a little bit later. That's the concept here. So I've prepared an example stock for today. It's never a sales pitch for a specific security, but let's look at NVIDIA. NVIDIA gets a lot of headlines, biggest company in the world. So what's been happening with NVIDIA recently? Why might, well, let's just throw out a general question. Why might an investor or a trader want to buy a stock in the first place? There can be a number of reasons, right? It might be that they really admire something fundamentally about the company. Might be that its corporate performance has been strong and increasingly strengthening over a stretch of time. How might we check on that? Well, we might go to our Analyze tab and look at the company's fundamentals. Let's see what's going on. Here's NVIDIA. There's what the analysts have to say about it right now. If I scroll down a little bit, maybe the investor or the trader has done some research into what that company does, and they see that maybe that sector of the marketplace is a growth area. I'm not saying that's accurate for NVIDIA. I'm just saying, generally speaking, maybe the company likes what people are saying, or maybe the investor likes what people are saying about the company. Maybe they like something about the company itself. Maybe they like its performance metrics. So for example, down here, Mary Burns is looking down at these metrics. What's been happening with earnings for NVIDIA? They've been going up. Dividends have been increasing. Not that they're terribly significant at this point. Book value, cash value or cash flow per share, free cash flow per share. And you got one little icon in the way. Sales going up. Are any of these trends guaranteed to persist? Of course not. NVIDIA might stumble, but there are a number of reasons why someone might be interested in buying a company. They might relate to those fundamentals that we just saw. Maybe it has to do with the sector. Let's go see what's going on with the sector. So NVIDIA is in the information technology sector. And I happen to know that we can get a sector performance chart here by typing in $SP500 and then it's hashtag 45. That's our information technology sector. If you don't know those, by heart, you can come over here to your watch list and go to the public watch list by Thinkorswim and look at the S&P 500 sector indices. There we are. But hashtag 45, there's our information technology sector. And maybe our investor sees, maybe there's some rotation of money into that sector where IT actually, or technology, I should say it that way, struggled for a few months, but then we saw a breakout through that downward sloping trend line, and then we're starting to advance again. Now, that might mean the sector is going to go for another run. It might not. But a number of reasons why somebody might be inclined to buy a stock: the fundamental health of the company, what's happening with the sector, or maybe it's just something that catches their eye on that stock's chart itself. Lots of technical traders out there. So let's go back to the NVIDIA chart. And what has happened over the last few months with NVIDIA? Well, it struggled to get above and stay above that 215 level for a while, bumping its way against its head. Let's see. All right, nice little sidebar. I was just reading to make sure I wasn't missing any questions there. But yeah, we were bumping our head on the NVIDIA chart at about that 215 level. And then we've kind of pushed up and through that, couple more days below 215, but now settling in potentially above 215. Let's just say that our trader thinks that with this broken resistance line, and this even looks like a bit of what we might call a bullish hammer, just an individual behavior in today's prices, where it looks like we're spending the bulk of our time toward the high end of the day rather than the low end. So maybe our trader thinks, all right, maybe prices could go higher. They might go higher. But even if they go lower, maybe I wouldn't mind buying these shares. So let's keep that 215 level in mind. Let's just say that maybe our trader thinks, well, if we could get down, maybe on the premise that September's kind of a weaker month for the year, could it be possible that NVIDIA may go down in price a bit? You know what, maybe we wouldn't mind buying those shares if we're closer to 215. Well, rather than waiting around to see if we could buy those shares for 215, it's possible we could just get into a contract with someone else where we agree to buy the shares from them for 215 bucks. That's what we're going to do today. So let's go structure our example trade here. I'm going to go to the trade tab. Let's go out to the 18th of September options. And this, let me get my scratch pad here. This is going to be our example trade. We are going to sell, well, let's just say we're going to short a put. All right, so we're going to sell the 18th of September 215 put. That's right down there at that support. And what's that trading for right now? Oops, let's scroll back up there again. There we are. Looks like that's trading between $3.90 and $4 per share. Let's say we're able to get $3.95 for that. If this is your first exposure to trading options, let me explain in pretty clear detail what we're considering doing here. So specifically, we're selling something. Just imagine, this isn't the way it actually works, but just imagine you're writing out a note that says, hey, random other stranger trader out there in the options trading universe, I want to enter into a contract with you. Here are the terms of the deal. I'm going to sell you this little promissory note sheet of paper that says, I will buy 100 shares of NVIDIA from you at any time for the next 18 days, or in other words, through the 18th of September, because today is actually the 31st of August, but through the 18th of September, I'll buy 100 shares of NVIDIA from you on demand, but I'm only willing to pay 215 bucks for those shares. Now, I'm not going to give you this piece of paper out of the kindness of my heart. You need to pay me for that. So for our guarantee that we will buy shares at a prescribed price for a prescribed period, we're theoretically getting paid. Obviously, we haven't gotten paid yet. And that payment, if we collect it, comes with this obligation but we're getting paid $3.95 to get ourselves into this deal. So yes, for some traders, they interpret this as, Cameron, this is a stock that I was interested in buying anyway. Maybe we like the fundamentals, maybe we like the sector, maybe we liked what was happening with the chart, maybe it was a combination of all of those three, maybe it's something else that motivated us to do this. But is someone else paying us to buy shares of stock that we were already interested in buying and at a lower price potentially than the current price of the stock? Yep, that's the deal. So that may sound like, oh, that's amazing. Well, maybe. There are definitely potential advantages to this sort of an approach to income. There are certainly potential risks, but let's just say we do that. As a matter of fact, I'm going to go ahead and do it while it looks like we might even be able to squeeze $4 out of this. $3.95 to $4.05. I'm going to click on the bid price and let's create an order to sell. Let's just sell one contract, that 215 put, for $4. I'm going to put $4 in here. Notice that creates a lock here. It's locked down. This is the least we're willing to accept. Might be able to get this filled. I'm going to click confirm and send, see if we can. Let's sell the one NVIDIA 18th of September 215 put for $4. If it fills, that $4 becomes the maximum profit of this trade. There's certainly risk. Look at that big, intimidating number, but we'll talk about that. And there is a commission to be paid that can chip away at the $400 if we collect that. Let's send that off. Let's see if we, oh, we did. Look at that. Filled it right at $4. I like it when I get nice round numbers, especially when discussing new concepts with somebody. So guys, we now have a contract. Let me remove this drawing. I'm going to remove this drawing and we're just going to focus on that 215 level. And let's actually move this. I'm going to edit this so that it starts just today. What is today? The 31st of August. There we are. There we go. So this is our contract price, and there's our contract time frame from today until the 18th of September. And here's where the stock is. So let's first of all address this question. Did somebody just pay us to buy the shares of the stock that we're interested in? Yeah, maybe. We now are in a contract where someone can choose to sell the shares to us if they want to. So let's talk about whether or not they're going to choose to, or what might make it more likely. Okay, that's largely going to be determined by what price does from this moment. With the shares worth $219, even though someone has the right to sell us shares for $215, do they have much motivation right now to do that? No. Nope. The shares are worth more than that. They could sell the shares to somebody else for $219. And if the stock price goes up from here, could it go up to 230? Could it go to 220? Could it go to 217? Of course it could. But if the stock goes up, now they have less and less motivation to ever sell those shares to us for 215. And if the stock keeps going higher and we hit September 18th and this contract has expired, maybe we never wind up buying those shares. Now that's somewhat positive, somewhat negative. If we really wanted to buy the shares, that was not our outcome. But in that scenario, what our outcome actually is we just got paid $4 per share on 100 shares. That's $400 minus that 65-cent commission, but basically $400. And we have no further obligation to do anything for anybody. We now have a realized income of $400. Trade's over 18th of September if this contract is never assigned. What if the stock goes down? Well, if it goes down, but it stays above 215, so we're at 219. Notice we just slipped to 218.92. What if we slip down to 216 by expiration? Someone has the right to sell shares to us for 215. Even though they can, they're probably not going to, almost certainly not. Again, somebody might get a wild hair and say, Cameron, I know these shares are worth 216. I'm just going to sell them to you for 215. I'll sell them to you at a discount anyway. It doesn't happen very often, but it's possible. Yeah, if the shares are worth more than 215, the most likely outcome by a long shot is the contract just expires worthless and we keep the 400 bucks. Now, this is where our plan moves more toward fruition. And this is interesting because some people would see this as a negative outcome. What if the shares came down below 215? Let's say they go down to 210. Well, we have an obligation here. Someone has the right to buy or sell shares to us for 215. They're only worth 210. Are they going to do it? Yeah, almost certainly yes. Especially come that expiration date. If they haven't done it already, they've got a quick decision to make. Hey, I can sell these shares for 215, or I can hang on to them and they're only worth 210. Yeah, they sell them to us at 215. And we now own the shares. And we bought the shares for a lower price than what they were trading for on day one. So to some extent, that's an improvement, isn't it? On day one, today we could have just bought the shares for 219 rather than buying them later at 215. So hey, we've improved that scenario, but we still are overpaying for the shares as of that moment. So it's not like a perfect scenario. If the shares are worth 210, we're required to buy at 215. We've overpaid for the shares by $5. Better than buying at 219 and they're only worth 210, but we are overpaying at the moment. But for some traders, that's completely fine. Plus, we did collect the $4 up front. So really, in that scenario, we're only underwater by about $1, having overpaid for the shares by $5, but we've got $4. We got paid $4 to get into this deal. And that might be a perfectly fine outcome for the trader who was looking for income and was looking to buy the stock at a lower price. Just be aware that this whole thing could fall apart. How could this trade just be devastated? Well, what if the shares absolutely collapsed in value? What if they did? Let's see if I can find an example. Yeah, right here, there was a pretty good downward move over a similar period of time. What if our shares went from 219 and they fell down to 190 bucks? And we have a contract that obligates us to buy those shares at 215. Now we might have to overpay for the shares to the tune of like 25 bucks. And it doesn't stop there. The further the shares fall, the more we might ultimately wind up having to overpay for the shares. So we do not want the shares to go into a full collapse mode. Sometimes a trader can get all starry-eyed about the premium that's being paid. Ooh, I'm getting $4 and I'm agreeing to buy the shares at a lower price than they are currently trading for. Both of those statements are true, but it can still not turn out to be a great trade if the stock collapses in value, right? So some of you are proposing other things that we might do. JDL might, you're exactly right. This is probably what we'll do with this position. If the stock falls, but it's not completely collapsing, if the stock just really falling down, even if we get assigned the shares, we may choose to just sell them. This is not what we want to hang on to. But if we just slip down below 215, or we just, for any reason, we get assigned those shares and we decide to keep them, well, at that point, we might start selling calls against that new share ownership. Now that plan actually has, or that strategy for how to manage this trade actually has a name. It's called the wheel strategy, where we sell a put to sort of set the wheel turning. If we get assigned the shares, well, we're now share owners, and we sell a call, get some more income, potential income, against that share position. And if those calls are sold or assigned, then we wind up selling the shares. We realize gain or loss on the stock, but then we have the two incomes from selling the put, selling a call, and maybe we do that over again. It's called the wheel strategy. If you want to learn about the wheel strategy, you can go to the YouTube channel. Do this. Here's a quick way to find this. We could just go back to the archives for this webcast series, or we could also just type in the word wheel here, and it'll do a keyword search through our session archives. And there's a webcast where we focused on the wheel strategy. The wheel strategy's first move, mastering the art of selling puts. So you might want to check that out. But let's go back here and let's just make a plan. We have this sort of ugly cluttered chart. Let me right click and I'm going to clear the drawing set. There we go. But let's draw a line in the sand. Let's say our plan is, we're trying to buy the shares at a lower price than what they're trading for. We're collecting a premium up front in our effort to do that. But if the stock really starts to collapse, maybe we want to pull the plug on this scenario. So let's have a plan in place. If we go down below these recent lows, what was that low? 207 and a quarter. Let's do this. Consider selling if support breaks. I always say consider because I don't do it automatically. Instead, we talk about it in the webcast. I like to do that on camera. There we go. Let's change the orientation here. Edit properties. Change the alignment from left to right so you can see the whole note. There we go. And we're actually already in this position. So guys, let me check your questions and see if I've missed anything. It feels like cash securement may require me to have a conviction in the handle to which I'm securing. Joseph, well, anytime, I think this is what you're asking. My apologies if this isn't exactly right. But yeah, when we're selling a put and we're doing this, if I go up here, you'll notice this is in a fake margin account. Oops, that's not what I want. We don't need help right now. Let's go back to the charts. Anyway, but when we sell in a margin account, there's a certain amount of cash, typically around 20% of the strike price of the put, that's required to be tied up in our buying power to cover potential losses on this put. But if we sell in like an IRA, then we'd have to cover this entirely with cash. Both of those, though, come with an obligation, a substantial obligation, where we might have to buy 100 shares of stock for $215. We just have to be prepared for that. If we go into this thinking, well, I know that conceptually I might have to buy the shares, but I don't really think it's going to happen. It doesn't matter whether we think it's going to happen or not, it still could. So we have to be ready. Yep. And there was another Beauty at Rest had asked a question here. Let's see if I can find that question again. If you don't want to be assigned, shouldn't your exit be the break-even price? If we don't want to be assigned, probably shouldn't do the trade. But yeah, having a specific exit at a specific price can theoretically reduce the likelihood of assignment, but it doesn't eliminate it, because somebody can always just get a wild hair, even on a contract that's just still way out of the money. They may choose to assign a contract. The assignment, we just don't know if we're ever going to be the one who gets picked to have the contract assigned. Yep. But exactly where we exit, yes, exiting at prices that are closer to the current price can reduce the theoretical risk of assignment. But the higher we snug up that exit plan, also it increases the probability that we're ultimately going to just exit and wind up with an unprofitable trade. There are pros and cons. Let's see. What else do we have here? Matybug says, wouldn't selling the call be better if and when it rises and the premium is higher? Ooh, it's a big question. That's a good question. Better, though, ooh, that's a loaded term. Better is not whether we get a bigger premium up front. Better is what happens after the trade is taken, and we don't know that. Yep. So it's an interesting question, and really, to do it real justice, I'd have to weigh a lot of pros and cons there, Matybug. There's not a short answer to that question. But what I can address is the concept of getting a better trade at the front end of a trade. I don't think that there is such a thing, because we don't know how each trade would have worked out ultimately. That's something that only time will tell. Good question. All right, let's see. I think that's going to be it. Yep, we're running up on the edge of our time. So guys, we've accomplished what we set out to do today. I wanted to talk about this concept. I'd call it the strange logic of getting paid to buy the stock you want. When selling a put, when entering into a contract, where someone else has the right to sell shares to the trader at any time, entirely at their discretion, at the other party's discretion. We typically only want to do this on shares that we ultimately wouldn't mind owning, maybe that we ultimately desired to own, but we have to also just be aware of the pros and the cons of that sort of an approach. So we've talked through if the trade works out, if the trade is going against us, if the shares fall hard in price, there can be a significant exposure to risk. So guys, time for me to let you go. We'll follow up on this position along with our other positions in future webcasts. But I want to make sure that you're taking full advantage of the educational offerings available to you from Schwab, starting with, if you're new to the channel, welcome, it's great to have you, but make sure that you are subscribed to the channel. It's called Trader Talks Schwab Coaching Webcasts, and you can subscribe just by clicking on the subscribe button down below the video right now. But our channel is where you can join our live streams, just like the one I'm hosting right at this moment. You can find our playlists of previous webcasts. You can also do keyword searches through those playlist archives to find webcasts of particular interest. Joseph, glad you find those archives amazing. Yep, you enjoy those. I also want to really suggest strongly that you follow your favorite Schwab presenters on social media. Barb and I are both very active on social media. You can find us and follow us on X. You can find and follow us on LinkedIn. But that is the place to connect with us in between the live streams. You can't email me, can't text me, but you can communicate with me through social media. You'll see that I'm very active here, over 6,800 posts to date. And if you reply to one of my posts on social media, I just try to reply right back to you. So Barb can be found and followed on X at Barb Armstrong CS is her handle. Mine is at Cameron May CS. Or you can hop over to LinkedIn. Just go to linkedin.com/in. And then again, my handle is Cameron May CS there as well. So to find me, it's linkedin.com/in/Cameron May CS. That'll take you right to my profile. Give me a follow. And if you reply to my posts here with a comment, I just try to reply right back to you as well. Hey, everybody, thanks for giving me your time today. Definitely appreciate it. I also certainly appreciate everybody that's clicked that thumbs up button. I can see over 100 people watched the live stream today. 42 have already clicked the thumbs up. That's amazing. Thanks for doing that. That's always like a pat on the back to your presenter. But also, it gives my videos a boost in the YouTube algorithm. It sends a signal every time a live attendee or someone watching on the archives clicks the like button. It tells YouTube, hey, this is good stuff. Show it to other people, and YouTube does. So it helps more people find these webcasts and learn about things like this concept of the strange logic of getting paid to buy the stocks that we're already interested in buying. All right, everybody. Thanks again. I will see you in a future webcast. Barb, thanks for helping out in chat. But I'll also look for you on social media, on X and on LinkedIn. Whenever I see you again, though, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.